Hi, good morning, everybody. We will start our third quarter 2020 market update review and webinar in about, let's give it 1 or 2 more minutes for some more folks I see are logging on to the presentation. I will be right back to get started. All right, welcome everybody. Thanks for joining us today. It's kind of an overcast day in here in South Florida, but we are happy you could join us today to review, what's been going on in the markets in the previous quarter, and then also we have a lot to talk about with the upcoming election, and just to kind of see what we have in store for year end. We have a great presentation for you today, and we appreciate you joining us. Just a little housekeeping before we get too far into the program. Today is about general information. General ideas will be discussed. Anything that we are reviewing is really more for a general concern. If you have any questions about what we cover and how it relates to your specific portfolio and your specific financial plan and retirement plan, please give your advisor here at Tobias Financial Advisors a ring. We'll be happy to discuss the current portfolio positioning or things we may be doing within your financial plan before year end. Just quick for a minute about who we are. Of course, we're Tobias Financial Advisors. My name is Matt Sainholtz. I am the Chief Investment Officer and a Senior Financial Advisor here at Tobias Financial Advisors. We were founded in 1980, so 2020 marks our 40th year anniversary, and we are really proud of our longevity and the fact that we are a growing team and we're able to meet and help more people achieve their goals along the way. We're managing over $400 million for about 200 private families and some 401k plans. We have tremendous years of experience, and education is very much a part of who we are. We have designations from the Certified Financial Planner, Chartered Financial Analyst, and Certified Public Accountants. So we are well versed in a variety of financial topics in order to serve you. We're going to have a special guest today, Michael Aroney. He'll be kind of giving some more comments towards the middle of the presentation, but Michael is a Managing Director and Chief Investment Strategist for State Street Global Advisors. He's responsible for expanding State Street's global footprint and thought leadership efforts through frequent contributions to the financial news, media, speaking engagements, and client interactions. He's well regarded, and we really look forward to having his long experience and being able to kind of talk about various issues that are facing the markets today. And we do welcome him. He is out of Boston this afternoon or this morning. About Tobias Financial Advisors and our overall investment philosophy is that, really your financial advisor and you are really developing a portfolio that's here to meet your goals. It's not about meeting the benchmark or beating the markets on a constant basis. Your assets is what you're using to fund your dreams and your aspirations. And so to order to do that best, we get to know you and your family and how you look at the world and how you want to operate and how you want to achieve your goals. So we kind of get a great feeling for your risk tolerance. And then we build a portfolio that combines various different asset classes, whether that's fixed income or bonds, stock markets or equity markets from around the globe, and that's in the stock world, and then in the fixed income world, we're talking about different levels of credit, whether that be corporate credits or government credits, and could be higher rated bond funds or lower rated bond funds, and we're really just putting together all these pieces of a puzzle to help develop and achieve your goals from a financial perspective. So, the main pillars of our philosophy really is diversifying broadly. Having too many individual stocks or individual stocks at all creates unnecessary business risk, and so we want to diversify our exposures, whether that be different size of companies, small versus large, or international versus domestic. We want to reduce our expenses and our turnover, and we also want to minimize our taxes wherever concerned. We don't want the tax man to take away all of our hard-earned earnings. So we're not only thinking about that from an investment perspective, but we're also thinking about that from a retirement savings vehicle, Roth IRA versus traditional IRA, and different types of 401ks. So we focus on what we can control. Obviously, this year has been a roller coaster of news events and market events. So we can't control all that, but we can control what we're doing within the portfolio. And so with that, let's take a look at what we've done over the last 12 months from a world perspective. This is a chart of the All Country World Index, which is just kind of a barometer of stock markets around the globe. And you can see, I would call that a V-shaped. I will call that a V-shaped recovery in the stock markets around the globe, where we saw the COVID crisis hit in March, pretty much. Maybe it started a little bit in February, but pretty much March, it was almost straight down. And then since then, we've seen a recovery, and we're going to be digging into a lot about that today, about what are some of the reasons for this? Will it continue? But want to just kind of show you where we've been before we talk about where we're headed. So what we've experienced has just been a tremendous downturn in the markets, and then a grind higher for various reasons, and that would include stimulus packages that were passed, and just kind of hopefully getting back into the economic form or economic recovery. So last quarter, the recovery continued pretty much across the globe, across the different various asset classes. We saw positive returns in the third quarter, over 9% in the U.S. stock market from the July through September time period. International developed stocks up about almost 5%. Emerging market stocks, countries from your traditional China, India, Brazil, these emerging countries, companies headquartered there returned 9.56% in the third quarter, and even real estate held its own, was up slightly. And then in the fixed income world, a slight increase with some of the returns there as well. But it's interesting, kind of towards the bottom of this chart, if you look under international developed, one of the worst quarters was in 2020 Q1, and then we've had a great recovery, at least in the U.S. The international has not quite recovered as much, but it's on its way. And we had a great recovery in Q2, having a 22% return. Then we followed that up here in the third quarter with a 9% return here in the United States. So just some more color around what we've seen year to date compared to last year and over the last 15 years. First, I will kind of draw your attention to the top right here, which is thinking about the world globally and how we're all kind of interconnected. So the United States accounts for about 59% of the world stock market capitalization. So, a lot of questions we have around, why do we want emerging markets in our portfolio? Or why do we need companies from Japan and Europe? Well, those are big markets as well, and that accounts for about 41% of the global market capitalization across the globe. So we don't want to have a home country bias, even though the past 10 years, I would say the U.S. has done pretty well compared to the international companies. But that might not be the same for the next 10 years going forward, and that's what we have to invest in and think about things going forward. And on the left-hand side here with the 2020 year-to-date numbers, This is as of October 15th. Some of these numbers, the U.S. has done very well and having a almost 9% return, where you have some of the international indices. This is kind of Japan, Europe, Asia, and the Far East down 6%. Looking at selected countries, year to date, the UK still struggling with Brexit and what that's going to look like. Ultimately, is down 24%. But contrast that to China, which has really recovered 21% and has done pretty well coming out of their COVID crisis. And so that has been kind of a tale of two different worlds, and kind of another reason why we want to stay diversified, because there is opportunities abroad as well. One more slide before we invite Michael in to hear his thoughts. So just kind of this chart, like to kind of, it's kind of a function of that we've seen record outflows of out of stock funds and stock index funds. So, basically that this has been a tremendous outflow year where people have just been selling their equities, selling their stock funds. And it's been almost since 1993 the worst outflow in stock investing funds. And even in the face of that, the stock market is actually up year to date. But when you look at different time periods where you've seen these outflows and previous crisis, the 2008 financial crisis, global financial crisis, where we had $52 billion of outflow in 2008. Well, these outflows typically precipitate a positive return. After 2008, we've had some really good stock performance years. Stocks, after they've had outflows in 2008, there was a 26% return the following year. 2011, there was outflows and had good returns. 2016, there's outflows and good returns. So it's the idea that what goes down comes back up, and that's where we want to take advantage of the opportunities that present themselves during the downturns when there is outflows. And with what we were doing back in March and April, when stocks were down, we were actually buying into them to take advantage of some of the dislocations in the markets. So that is kind of a quick review of what we just experienced in the third quarter. We're having a very positive returns during those time frames. And so let me ask Michael and bring Michael in. So Michael, welcome. Thanks for joining us today.
My pleasure, Matt. Thank you for having me. Appreciate it.
Great. So, I kind of just walked through some of the slides here about recent performance, and could you just give us a little bit of your thoughts of what's been, you've had these negative impacts in the economy. We had COVID, unemployment still lower than what it was, but higher than what it used to be pre-COVID, and yet the stock market continues to rally from these lows. So, what can you explain the phenomenon, or what is going on here? Can the market continue like this?
Yeah, Matt, I think it's the single biggest question that we continue to get from investors is how can the market be performing so well in the face of so many challenges? And so from my perspective, I think there's three things that are really driving the market's positive returns since they hit their lows back at the end of March. And so in many ways, investors and market participants are looking forward, not backward. So the first thing I think that really helped markets was the massive policy response to help combat some of the most negative effects of the pandemic. So as we know, the Federal Reserve lowered interest rates and also agreed to purchase a significant amount of not only treasuries and mortgage-backed securities, but even for the first time ever, investment-grade corporate bonds and junk bonds in that regard, and even serve as a backstop to things like municipal bonds and small businesses. And so this very aggressive and I don't know about highly unusual, but somewhat historic move helped provide much needed liquidity, a smooth functioning market, and a bit of a backstop for investors. Secondarily, the fiscal policy also responds. So although we seem to be stuck right now, and we'll get into that in a moment around fiscal policy, the government did pass 4 pieces of legislation worth north of $2.4 trillion to help support the economy, including the extension of unemployment insurance benefits and an increase in those benefits to $600 a week, as well as direct checks to individuals of $1,200. So that massive policy support helped provide an effective bridge from a very brief recession to what's now at least an undergoing recovery. The second thing that drove markets, in my opinion, is that I think in many ways, investors were bracing for the worst. They were expecting Depression era-like earnings and economic figures. And the numbers were poor, but they were much better than anticipated. And we avoided some of the worst fears. So I know it's kind of a little bit psychological here, but I think what's interesting is that markets surpassed very low expectations. And the worst fears, the things that we could imagine to be the worst, didn't actually come to fruition. And so markets were pleasantly surprised by that. So that was good. And I think they're looking forward to next year when growth and earnings will rebound. And then finally, the third thing I think that's driving markets is I do think there's a resiliency that despite the pandemic's challenges on the health front, the social front, and the financial front, there is an underlying feeling that we will, in fact, move beyond the pandemic at some point. A cure or herd immunity will be achieved, and we'll be able to get on with our lives. Yes, things won't return back to normal, like they were, but I think there's a kind of a natural pivot point. So Pfizer, the big pharmaceutical company, Moderna, the biotechnology company, believe that they could have a vaccine approved for emergency use by the end of this year. How it's distributed to how many people, under what timeline is admittedly going to be longer than all of us would like, but progress has been made. And I think as the second half of next year comes on, I think there's a feeling that perhaps the COVID-19 pandemic will be put behind us. So I think those 3 things have been driving the market positively.
Mm-hmm. Yeah, no doubt. There's the innovation, and I'd like to think the world's smartest and folks with the most resources have been trying to tackle the COVID crisis for a few months, and hopefully we'll get that good news eventually, where there is a vaccine that we can all trust and utilize. That'll open up not only our economy but also the world economy. So that's good to hear. So what about thinking about, okay, so those are some positive aspects. What risk could derail this rally? And I know we have a big event here in the United States in a couple of weeks with regards to the elections. But I want to talk a little about risk, and then we'll delve into the election piece of it. So what are your thoughts about just general risk that could slow down the rally, or just kind of really just take us off the rails?
Right. So there is a chart here that we have before you. So State Street Global Advisors, that's right there, Matt, perfect, is a 3.1 trillion asset management firm. So kind of one of the largest in the world. We also have more than 30 trillions in assets under custody. And so we get to look through on how a lot of investors are positioned. So what this chart indicates essentially is that it's trying to gauge whether investors are becoming more risky or more risk averse. And 100 is a neutral level. And so numbers below 100 would signal that investors are becoming risk averse, and numbers above 100 would indicate that they're adding risk to their portfolios. And these investors are large, sophisticated money managers and institutional investors that we're trying to gauge. And you can see the kind of the ebbs and flows. So in terms of the risks, I think there are 4 well-known risks that investors are concerned with. And interestingly enough, kind of in the final few weeks of September, some of those risks began to tilt a little bit more negatively. Now, again, nothing overly concerning, but I think some of the optimism shifted a little bit towards pessimism. We saw the market sell off in the final few weeks of September, but nothing, overwhelming, and certainly has rebounded here so far in October, as your previous chart showed. So what are the risks? Well, I think the first risk is concerns around a COVID-19 resurgence. So we're seeing some unsettling news in Europe where the cases are climbing. We've seen places like the UK and other major countries in Europe begin to take on additional restrictions. So they had opened up, cases were seemingly kind of getting better, but now they've started to rise again, and they've taken some actions to restrict gatherings. They've encouraged people to work from home, that type of thing. So that's a little unsettling. Here in the US, we're on the cusp of flu season. So typically from the end of fall, 13 weeks kind of to early winter is usually the peak of flu season. And so that's a little unsettling for folks. We've started to see some of the cases rise as testing has increased from that standpoint. And there's a very public debate going on between politicians and health experts about when a vaccine will be ready, to whom, and how long it will take. And again, that makes folks unsettled, not knowing, when that might occur from that standpoint. So I think there's some concerns around the potential for an increase in the number of cases. Now, someone pointed out to me, I think this is kind of interesting, one of the maybe silver linings of what's happened is everybody's gotten flu shots. And not everybody, but you get the point, most everybody. So there's been an increase in flu shots. Folks are washing their hands more regularly. They're staying socially distanced. They're wearing masks in most instances. So it's interesting, this flu season may not be as bad, given some of the kind of things that we're doing to prevent the spread of COVID. Flu season might actually be a little less severe than anticipated. We'll see. I'm not making that as a forecast, but it could happen. The second risk really has been driving markets in the last week or so is falling over that fiscal cliff. So as we know, Democrats and Republicans are battling it out around another stimulus package, and both agree that one is needed to keep the recovery that's started going, buying us some more time. And even Chairman Powell of the Federal Reserve has said, we need more. If we don't get more fiscal stimulus, this could be catastrophic. But the sides are wide apart. Now they're trying to get a deal, and markets have been going up and down yesterday because Nancy Pelosi over the weekend said, oh, I'm only 48 hours and that's it, your deadline's passed. Markets were up earlier today because it looked like maybe they were making some progress. So there's movement kind of from that standpoint. So there is a risk here. Third risk is US-China tensions. We've seen that really play out through the course of the year. Most of it's been centered in the political arena. But in August and rolling into September, with President Trump's executive orders on WeChat and TikTok and some other measures, it started to leak a little bit into the economic arena. So it's worth keeping an eye on from that standpoint. And finally, the election, which I know we're going to get into in just a minute, but that's got folks a little bit unnerved, a little bit anxious, as the odds were increasing that perhaps we would get a contested election. I think investors have struggled to kind of understand what that looks like. Now, if you think about it, after the first debate, again, I want to make it clear, I'm not making any political opinions, just kind of observations of what happened. So after the debate at the end of September, President Trump was reluctant to agree to accept the results in a smooth transition of power. Now, it could be political posturing, it not. So that's a little unsettling. Equally, so in case you think I'm beating up on President Trump, equally, the Biden ticket has failed to rule out some of the most kind of aggressive policies in terms of stacking the court and changing the filibuster rules. So they've failed to rule those out. So as an investor trying to gauge kind of the outcome here, all of a sudden some of the kind of crazier things that could happen are increasing a little bit, nothing crazy, and are hard to gauge from that perspective, and that's unsettling.
Yeah, absolutely. I think that is a great segue to just kind of talk a bit more about the market and maybe a little bit of the differences in between Trump and Biden and what that might mean for various asset classes, or just where we are, kind of what we're seeing today, and what the most recent polling suggests is that Biden is taking more of a lead here with about 2 weeks to go, and where we'll end up here in Florida, it seems like a very close race. But on the national level, we have two very very different opponents. And you mentioned the contested election. We had that during Gore time frame, and so the markets have seen something on along those lines. And I don't know if you have any statistics for us today on that regard, but maybe you could just talk a little bit of what a contested election means and what that might mean for the markets.
Right. First and foremost, I think that investors tend to overreact to election outcomes. And that's really where kind of Tobias Financial Advisors comes in to help provide you that long-term discipline investment approach, not to get influenced by the kind of short-term noise of the election and the emotion that it can derive for some folks. So at the first kind of, in an aggregate kind of broad strokes comment, I would encourage folks, whether your candidate wins or your candidate loses, not to give in to that emotion as it relates to your investments. You have a disciplined investment approach, a process, and a plan in place. For many of you, not all of you, you have a long-term investment horizon. Let the benefits of diversification and that discipline work for you. In terms of the election, it's interesting in that in many ways, Clinton had a bigger lead than Biden does at this point in the election. And so in many ways, I do think that most of the investment research that I see, folks have been biased or concluded that given Biden's lead in the polls and the challenges with the pandemic, that that Biden is going to win. And what's interesting is that there is an element of history on their side. So a US president incumbent has never been reelected if a recession has occurred within 2 years of the election. Now, we had a brief recession brought on by the pandemic earlier this year. It was very small, very brief, and we're recovering from it. So some are beginning to anticipate that maybe President Trump will suffer the same fate. And we've started to see some shifts in portfolios to address that. Now, for me, I've been suggesting, hold on a minute, I joke that investors have short-term memories, but do they have amnesia too? So many polls indicated back in 2016 that Trump would lose and that Brexit would fail, and we got surprising outcomes. So I do think that this election is likely to be a bit closer than people are expecting. Biden's lead in the polls, particularly in swing states, has been narrowing. So there's a group called Real Clear Politics. 2 weeks ago, they take a summary of all the polls. They were forecasting that Biden had about a 66% chance of winning. Today, that number is a little bit below 60%, around 59%. So I think as we head into the final few weeks here, things may be a little bit closer than folks are anticipating from that standpoint. Now, things aren't exactly the same here headed into the final few weeks. Unlike Hillary Clinton at the time, Biden has a cash advantage relative to the Republicans. That wasn't so back in 2016. Biden is popular among both seniors and women and polls better than Clinton did. And COVID, so what we've been saying to folks is that historically, the election outcome is often driven by the economy. So much so, in fact, that the S&P 500, if it's rallied the 3 months before the election date, kind of think about that kind of August, September, October timeframe. If it's rallied during that time, the S&P, it's been a very good predictor of the election outcome. This time, that might not be the case. So one of the things we've been saying is that the election itself is a bit of a unicorn. And that's largely driven by the pandemic. we haven't really experienced this before. So it's really difficult to look at past elections to suggest that that what to expect this time from that standpoint. And we think this is a little bit unique. Not only that, there's a small percentage of undecided voters this time around. So most folks have already made up their mind. In early voting and mail-in ballots, I think more than 20 million people have already voted. My wife and I voted on Sunday here in our hometown, for example. So there's some really unusual aspects to this. Matt, in terms of the uncontested, just quickly, we do have some experience in the Gore-Bush. Floridians kind of felt it the most. It lasted 35 days from the election ultimately to the Supreme Court decision, and then Gore conceding the election. During those 35 days, the S&P was down a little bit more than 8%. But Matt, you made a comment earlier. You showed the chart with the ups and downs of the year, and then some of the flows. What's interesting is that proved to be a good buying point for investors, in that once markets were down, this did prove to be an interesting entry point for investors to buy more stocks as they rallied from that standpoint. Things are a bit more divisive now, to say the least, right? That might be an understatement. And so we could expect maybe a little bit more volatility and maybe a little bit further on the downside. But once the outcome is determined, I think the outlook for stocks is pretty good.
Yeah, I think that's one of the, I appreciate your comments. The first comment you made initially is definitely something that we've been trying to communicate to our investors, is that it does, even in a presidential, whether your candidate wins or loses, you usually kind of feel that, you don't want to overreact. You don't want to overreact because there's also, of course, the Senate and the House. And a lot of the campaign posturing is just that, campaign posturing. And when push comes to shove, they might not be so extreme with some of their campaign promises when the actually laws get put into place. So we're watching carefully with 2 weeks to go, and we're not going to overreact or shift the portfolios dramatically. Staying the course is something that we truly believe in, and as the COVID pandemic has been any indication of validating that philosophy, we could have changed our philosophy during that. And in hindsight, the comeback, we could have missed out on some of the comeback if we got too conservative during that time period. So there's a lot of emotion in this campaign and this presidential election, and there always seems to be, but we want to stay the course as best as we can. There is one piece of it, though, as far as international markets, and if you could talk a little bit about international and the outlook for emerging, knowing that when you look back over the last 10 years or so, the United States has been a leader from a return perspective over the last 10 years, and maybe your thoughts just generally on the international and the emerging market, the valuations where they currently stand today. If you want to throw in a little bit about, which policymaker may be better or worse for international markets, we'd love to hear your thoughts.
Sure. So it is true. Both international developed markets like Europe and Japan have lagged the performance of the United States, emerging markets as well. And so that has many investors who have a value philosophy or approach, and those that believe in mean reversion, that things tend to balance out, which is often true from investments. And I think the chart that Matt just put up kind of demonstrates that, right? It's not as if one asset class is consistently at the top or the bottom. They tend to mean revert over time. So the idea that both international and emerging markets have underperformed the US, I think has value investors curious, and the expectation that mean reversion. So what might cause that? Well, I think there's a couple things. Certainly a rebound in global growth. So growth in Europe, better growth in Japan, and even in emerging markets, I think would help international markets. Another tailwind for international markets is the fact that the dollar has been declining some. So given the fact that the debt and deficit have been rising as a result of increased spending, not only from our response to the pandemic, but also as a result of the 2017 tax cuts. So we've been collecting less revenue, and we continue to spend a good amount more with those fiscal policy packages. As a result, the debt and deficit situation has worsened, and the Federal Reserve is keeping interest rates really low. As a result, the dollar's been declining. Well, that's a tailwind for some of those international and emerging market investments, and works as a support system. So the dollar had strengthened last year and over the last couple of years, but has weakened, has softened some this year. So that's a tailwind, as is relative value. So stocks in Europe and Japan and even emerging markets are cheaper than they are in the US. And from that standpoint, if you could get some better growth. So in terms of the candidates, I do think there's a belief that as you look at the stark contrast between candidates, and again, this isn't a political opinion, that Trump is a bit more America First principles, isolationist, weakening of global institutions. Think of the World Health Organization, think of NATO, think of kind of withdrawing from the Iran nuclear agreement. I'm not saying these are bad decisions. I'm just saying that they withdraw kind of in a little bit more of America's first, less globalization, tougher on trade, immigration. If you contrast that to Biden, it's likely to be kind of a throwback to Obama era type policy with a progressive kind of liberal twist. So more multilateralism, like the Paris Agreement, like the Trans-Pacific Partnership Agreement, the TPP, for example, more globalization, and more diplomacy on trade. So again, regardless of whether you agree or disagree politically, I think there's a feeling that the Biden administration might be more beneficial to international and emerging market stocks going forward.
Mm-hmm. Right. So I appreciate that. I know we could keep this conversation going all day, but I'm going to move on and cover some points of optimism. Some we touched on. Feel free, Michael, if you have any extra comments in these couple of bullet points here, and then we'll open it up for maybe one more question before we wrap up today. But what's optimistic? Kind of just exactly what Michael just covered, where we have a U.S. dollar weakness could be a support for emerging and international markets. And the second bullet point, I think, is regardless of which candidate comes on board, you mentioned Jay Powell arguing for more government support to keep the train moving, the economic recovery moving. And I do think we'll get some sort of stimulus here in the United States, whether that's before or after the election. So I think that will be also a beneficial point for stock markets. And then we have low interest rates around the globe, and also Europe and other countries thinking about spending on infrastructure and things of that nature. So I think we're going to continue to have some economic resources pumped in, which will be beneficial for our growth outlook. And then sometime down the road, we'll have to figure out how to pay for some of this debt, but you don't worry about that too much when your house is on fire, so to speak. You have to do what's best at that time, and then we'll clean it up down the road. So we have still some good economic data coming in from various countries, and so even in the U.S., unfortunately, it's not let's call it an even recovery, where we do have some of the more affluent folks and white collar jobs still being able to save, and unfortunately some of the service sectors industry and some other industries, travel industries, aren't as quick to bounce back, but we do see higher savings rates being a good indicator that the households are mostly holding up during this, and if we get that extra stimulus, that should be beneficial as well. Some points of caution, we do have this overhang of the U.S. election, which hopefully will just be cleared up in 2 weeks, regardless of who wins. We're rooting for a not contested election where we actually have pretty much identified the winner within either election day or really close to it. We expect the federal funds and the economy, central banks around the world to have zero interest rates for quite some time. And that vaccine that we're talking about, it's going to happen. It's just a matter of when. Is it going to be 2021 or, God forbid, longer than that, to have a really mass-produced weapon against this pandemic? So it's never always rosy or always pessimistic around here. We have to realize that not one data point you can predict the market on. Just realize that long term, capitalism works, that our U.S. system does work, and we've seen some rough patches before, and we continue to prosper and move forward. And that's what we'd like to do with your portfolios. So that said, I do have one question coming in from Michael, and it's kind of regards to the low interest rates, and should we be worried as investors or as mortgage holders about inflation? People can think back to the 70s of really high hyperinflation. What are your thoughts about either near term or what could cause some runaway inflation in this environment?
Yeah, so I think it's difficult to see, especially for those that were familiar with the incredible inflation of the 70s, for that environment to reoccur. And if you think about it, there's some pretty strong structural forces that will prevent that from happening. First, the incredible amount of debt, not only here in the US, but kind of globally. So typically, if you think about it, just think of your own personal situation. If you were highly indebted, much of your income, your spending, would go to interest payments on that debt, right? And so, although interest rates are lower, so the ability to finance it is cheaper, the more debt you have, the more that goes to interest payments rather than productive uses of that capital. So the amounts of debt everywhere certainly are a challenge for inflation. They tend to dampen economic growth, which tends to dampen inflation. Another is the demographics. So not only in the United States, but throughout much of Europe, Japan, and even in China, for example, the demographic is aging. And typically, the older you get, the less you consume. So again, it's hard to see significant kind of tailwind for inflation. Now, and then finally, there's disinflationary forces of technology. If we think about the impacts that technology have to ultimately lower prices for many of us, it's that. So those are all structural long-term. In the near term, you have an elevated unemployment rate, a labor market that has recovered half of the job losses from March and April, which is great accomplishment, but the next half is going to be a lot harder. And we're already seeing that in some of the economic data. So still the number of people unemployed is likely to keep wages suppressed and inflation at bay. So although we will pivot from deflationary fears to more normal inflationary environment, I think it'll be difficult to see inflation really ramping up until economic growth really starts to reaccelerate much more strongly.
But that seems to be kind of the general consensus. That could be a few years or more away.
I would agree with that.
Okay, very good, very good. Well, Michael, we really want to thank you and State Street Global Advisors for your time. You had provided a lot of great insights into where we are in the economy and what we can expect from the presidential election, all the way to the U.S. dollar and to the most recent inflation. So we really appreciate your thoughts. And we do have one more question. If you have one more minute for us, we just have one more come in.
Absolutely.
Well, I guess this is going to come into the more of the political spectrum and the Supreme Court, and what would maybe potential market effects or of the Supreme Court and possibly doing away with the Affordable Care Act. Any thoughts on of kind of a decision there, and who how to think about that as far as in the context of your portfolio?
Yeah, so it's interesting. As many know, that a Supreme Court case is headed to the Supreme Court on November 10th. It's a challenge to the Affordable Care Act. And so it'll be interesting from that standpoint. As it relates to markets, if in fact the Affordable Care Act gets curtailed, gets reduced by the decision, you could see a rebound in healthcare companies like HMOs, for example, health insurance companies, that type of thing. Again, not a political opinion, but it'll help support their earnings from that perspective if they don't have to kind of cover as many folks. I'm not saying that's a good thing. I'm just saying as we relate to the markets, you could see a rebound in healthcare should that happen. The more that healthcare coverage gets expanded, those types of things, universal healthcare coverage, you typically see healthcare providers and insurance companies struggle. You know, it impacts their profitability. So again, I'm not saying it should be all about profitability all the time, but that's likely the market reaction you'll see to that decision from that standpoint. There's obviously, it seems as though the Republicans are eager to try to get Amy Coney Barry seated as part of that decision in November. We'll see if they're able to do that in time or not from that perspective. But the Republicans will continue to try to curtail some parts of the Affordable Care Act. If they're successful, you know, healthcare might get a rebound. If they're not, expect it to continue to be challenged a little bit.
All right. Well, I appreciate that. I appreciate your thoughts. And once again, thanks for joining us today. This has been very helpful, and we really appreciate your time. So thank you, and stay safe. Take care.
Great. Thanks, Matt.
And everybody, please, thank you for joining us today. We hope you learned something today. And again, if you have any additional questions about how this may affect your portfolio, your financial plan, please give us a call. We're always available to speak to you and help you understand, you know, how it is and how these decisions and how these markets are performing to help reach your goals. So take care, and we will speak to you next time. Have a great one. Bye-bye.